All right, welcome to Tax Tuesday. We're going to let everybody pile into the room because gosh knows there's a line. There's a virtual line. All right, so if you're watching out there, first off, welcome. This is Tax Tuesday. If you can, just because it's kind of fun, there's a way to make a reaction. You can do a thumbs up or a cry face or all sorts of cool stuff. But react if this is your first Tax Tuesday. Let me know if it's your first Tax Tuesday. There's a bunch of thumbs. There's I don't see there's some is that,
So,
is that
yeah, confetti.
confetti?
Yep.
It always looks like an ice cream cone, but and there's a heart for you. Definitely for you.
Excellent.
They will. All right. And I see Sherry out there. Welcome again. So some of you guys, I know your names, I know your faces many times. So there's some first timers. Well, this is what Tax Tuesday is. We're going to go through and we're going to answer a bunch of questions and we're going to allow you to answer or ask questions. We have a huge staff on right now. Trisha, Jen, Jeff, Jared, Dutch, Amanda, Patty, Matthew, all waiting to answer your questions. And you can ask in the Q&A. And you can even chat in the chat, and I'll give you a chance to use that in a second. So, but what we're going to do is go through about 10. How many questions?
We got 10.
10 questions that Elliot picked from our emails that we get in the 2 weeks in between these. And we get hundreds. And we try to answer them all, but then we pick ones that seem to be popping up commonly. And we pick the ones with the worst grammar, apparently. Somebody says Q&A. Q&A says turned off. Oh, that's not very nice. Can somebody turn Q&A on? If not, we will make sure that we get you on chat. All right, let's go over what it is. We always say that we're bringing tax knowledge to the masses. What we're trying to do is just demystify this thing called the Internal Revenue Code, which is very, very long and very complicated. You used to think of it like poetry. You had to drink a little bit, then maybe some of it makes sense because gosh knows Congress wasn't thinking when they wrote it, and they definitely like their own words and they like making things complicated. For example, they can't say 14 days or less. What they can say is less than 15 days, which not very nice. Have you guys fixed Q&A? Try Q&A now. There we go. So you can ask live questions in the Q&A. I see it is working. So you can ask away. If you get into things like, hey, can you do my tax return? We're going to say, no, you need to become a client. But if you say things like, hey, I paid my kids some money last year. What are the rules for having kids as an employee of your organization? Things like that, they will absolutely answer. You can also email in your questions to taxtuesday@andersonadvisors.com and we will answer them. Why do we do it for free? Been asking myself that for years.
I do it because he does.
Blame it on Elliot. It's Elliot's fault. No, I believe in reaping and sowing. So it's one of our company values that we just believe that you teach. And if you guys want to become clients, you could absolutely reach out. And yes, Sherry, because we love you. All right. If you need to have a very detailed response, we do have a service called Platinum that allows you to talk to our attorneys and our accountants. We literally have a room like this open every day from 9 to 2. But unlike this, we can take you into a private room and have a discussion with you where you're not being overheard by everybody. What we do here is we turn off the chat and we turn off the ability for people to see other people's chats in case you say something that's incriminating. We want to make sure that we get to you. Just kidding. But if you don't want everybody to know your business. And in that particular setting, in Platinum, less than $100 a month, you can talk to the attorneys and accountants and get all the advice you want. And you can go in there daily. If you felt like spending 5 hours, 6 hours a day, you could. We don't restrict it. What is it, 9 to 2? So how many hours is that? 5 hours a day. So you could go, and we do themes and all stuff. The whole idea is that we want to have a little bit of fun. We want to take the fear out of this and enable you to keep more of your money in your pocket. Because frankly, our position is it's better with you, better served. You guys do better things with it. You guys help your families out. You help your communities out. Government's pretty good at giving it away, but they're not very efficient.
No.
So let's keep it in your pocket. So it'll be fun. All right, let's get into the questions. So we're going to read the questions for your first time. We go through which questions we will be answering so you can see, so you know, hey, this is really important to me. I want to stick for that. And if you just look at it and you say like, oh man, there's only 3 here that are relevant, you know which 3 are coming, and that way you can make sure you pay attention when those happen. All right, let's get into it. You ready?
Yep.
You ready?
Good to go.
All right. For an LLC that opted to be taxed as an S-Corp, is it better to not distribute the profits and let retained earnings grow on the balance sheet and invest retained earnings in stocks or other investments in the name of the LLC? I love the fact that they keep saying retained earnings. Somebody's been watching YouTube. All right, so we'll answer that one. I am considering signing up with Anderson and contemplating having you amend the last 3 years, as I don't think my CPAs or TurboTax gave me all the write-offs that I was eligible for. TurboTax, I'd let TurboTax. Yeah. So I don't think they gave me all the write-offs that I was eligible for. Really? As a real estate investor, I'm pretty sure you're right. I think I may qualify for a greater return, but also don't want to automatically trigger an audit. So good question, and we'll go through that. I'm assuming you had a really good reason for picking that question.
Yep.
Can I continue funding an HSA account if I am no longer employed by the company that offered it, but still have the account? Does it make sense to place it into a HSA investment account? So, good question and interesting answers on those ones. I know HSAs, a lot of confusion, so we'll get into that. I have a K-1 that will be late from the sale of an apartment complex in Georgia. I am a married filing separately taxpayer. Okay, I will do an extension, but still have to pay tax in April. How do I know how much to pay without the K-1? I went through a similar sale last tax season and had to pay a late fee due to the late K-1. I'd like to avoid that again. Great question. We'll go through that. What are the benefits of having children as employees? Are their education expenses eligible for payment by the company? Good question. Let's see if I can move this. Oh, wow. These are some lengthy questions. If we live in our rental house for 2 of the prior 5 years to avoid full taxation on capital gain, take advantage of the $500,000 exemption for married joint filing, can the remaining amount we will pay in taxes be offset? Can the remaining amount we will pay in taxes be offset by losses in our other rental properties? Capital if we qualify as real estate professionals during the year for filing. Good question. Like, I'm going to break this one into pieces. I'm going to let you break it into pieces. Example, if we purchase another property, cost seg it, can those potential deductions be used to offset the taxes paid on the primary residence sale? Interesting. Somebody's thinking. Good. How long do I need to have a property in service to rent to be able to deduct bonus depreciation from a cost segregation study? Really good question. Surprising answer, by the way. My asset is in a self-directed IRA. So when you see SDR IRA, that means self-directed. I'm assuming if I sell it, the money is considered income and I'm taxed on it like any other income. Also, if I use the money from the sale of that property for the purchase of a different property not kept in the self-directed IRA, can I avoid taxes? What is your suggestion in this type of situation? Great questions. Liking these. They're long, but excellent. All right, last couple. Just started an Inc. taxes as C-Corp. What is an accountable plan? Is it something I need to join before I can get the benefit of it? Can any reimbursement be expensed with my personal name and get reimbursement like health, dental, vision, cell phone, etc.? Do I need to have my cell phone account in the business name? You know, I actually think a lot of people have this question and just are afraid to ask. So I think it's a good one. Hi, Toby. Hey, Does the assignment of beneficial interest in a land trust count as an installment sale for tax purposes? Who's responsible for the property taxes in such a transaction? Really good questions.
Yep.
You're liking
Some,
this.
some confusion out there, I think.
Just a
misunderstanding.
tad. You got it. But this is what we're here for. This is where it's fun. And if everybody thinks they already know the answers, I don't know. Like we got to dig into them, but I'm always surprised at how there's always nuances, right? And every time I think I know something, then I'm realizing that I don't. And I bring Elliot along to make me look stupid once in a while. He's good at that.
That happened never.
Yeah, it does happen. Happens a lot. And speaking of, if you want to make, look at some of these pictures they use on my face. Like this is like,
Green loves those.
yeah, there's a reason we do it. Apparently people click on it. But if you like this type of thing and you want to see the replays, especially, join our YouTube channels. There's two of them, myself and my partner, Clint. You'll see the replays, I believe, if you are clicking on mine. And also there's a ton of, I think we have over, how many videos? 793 videos. So if you're really bored, you can just start busting through them. It's not as good as Game of Thrones, maybe, but
Close second.
yeah, actually, somebody gave me a thumbs up. See, somebody's watched all 793 and they're like, man, this is great. Also, we have two tax, and there's another one. We have two tax and asset protection events coming up, April 6th and April 13th. They're coming up. Get more. See, all I have to do is ask for it. This is awesome. But we're doing the virtual events. We just had a live event in Orlando. If you were in the Orlando or we're with us in Orlando at the live event this weekend, give me a thumbs up. Let me know who those folks are out there. I told them that if they put Orlando and they sent in to Tax Tuesdays at Anderson Advisors, that you would answer.
Yep.
And
Well,
that we would pick them.
give
So
special attention.
we're going to give
to
you
it.
guys some special attention. Look at that. There's a bunch of you guys.
There
So
it is.
we had a little bit of fun. We had 4 days. Woo, 4 days. 4 days. It got intense, but we had a lot of fun. I got to meet a lot of y'all, and it's like a lot of it over and over again. It's like, hey, I've been watching you on YouTube. And it's like, great, this is awesome. When's the next one? We have one coming up in June in Texas. Don't ask me why we're doing it in June in Texas, other than we want you to melt. Like we're really worried about you guys not sweating enough. So we said, let's do it in June. I think we're in Dallas or something like that. Maybe Patty knows, maybe somebody knows. I think it's coming up. So maybe I'm not supposed to announce that until we have it nailed. Dallas. We're in Dallas end of June. So we want to make sure it's really hot. No, I'm just kidding. We're inside. We have air conditioning there and flushing toilets. So
Unlike our office,
I'm like, what?
we had all the problems with our our plumbing here at the Rainbow office. Why these guys were down in Orlando? Yeah.
Couldn't flush the toilet?
Yeah, you didn't hear about any of that. Huh?
No, I did not. Sounds like a really crappy situation.
Yeah, it was.
Get it? I don't have the buttons anymore. Like my buttons are gone. Otherwise I would press a button and it would go. All right. If you want to watch the replay, go on and click this link, aba.link YouTube. And if you subscribe, you'll get the replays. Yay. And somebody says, are we doing Orange County? We're talking about it. Would love to. I was just there in Terranea with DLA Piper doing a tax event. Yes, I like to go to tax events too. And I was like, this would be really fun. It was really beautiful there. So I'd love to do that with y'all. How many of you guys would like to do Southern? Give me a thumbs up if you'd like us to do a live event in like Southern California. Right in their noses. Yes. Okay. Oh, we got a whole bunch. Look at this. We got one. All right. So we will, yes, San Diego. We used to do those. We used to do those. All right. Let's get into this fun. So there's a lot of thumbs. Well, apparently somebody says Hawaii. We do Hawaii too. Like we need to do how somebody says New York, New Jersey.
Maybe the California franchise.
Wait. I'm gonna give you the look for New York right now, guys. Like any business owner. Yeah. Los Angeles, please. Yes. Come to San Diego. I'll pick you up from the airport in a limo and you can stay free. But see, already. Patty's on it. She's gonna be like, sure, we have an event. Where's your Airbnb? All right. For an LLC that opt to be taxed as an S-Corp, is it better to not distribute the profits and let the retained earnings grow on the balance sheet and invest retained earnings in stocks or other investments in the name of the LLC?
All right, so yeah, a little bit of a trick to this as far as knowing your terms. The profits are automatically going to come down and hit your return. You're going to have to pay tax on those because it's a flow-through entity as an S corporation. So if we had $100 of profits, keeping cash in or not really doesn't matter. You're still going to pay taxes on it from that aspect. You could, if you left the cash in though, and you had enough other cash somewhere to pay your taxes from that, you may not have to pay a reasonable wage on your S corporation because that is determined by the cash that you take out, whether or not you have to pay a reasonable wage. So there'd be one aspect there. Further getting into the investments and things like that, we may want to consider, would you want to have those investments in an S-Corp? Because maybe the nature of your S-Corp is something you're a doctor, high chance of litigation. You may not want to have investments in there. We like to keep investments outside of our S corporation. So it would be one of those that depends situation by situation, but more than likely, you're probably not going to want to do your investments in that same S-Corp. And again, the profits, at least from a tax perspective, are going to flow through anyway. So you may want to just take the cash out.
Yeah, I think you just hit on some really important issues. So like, first off, when you see LLC taxed as an S-Corp, just know an LLC doesn't exist to the IRS. They don't know what it is. So you have to tell them, hey, it's either a C-Corp, S-Corp partnership, ignore it, called disregarded entity. But an LLC is not a tax treatment. So this is really, it's an S-Corp as far as the IRS is concerned. And then, as Elliot just said, it doesn't matter whether you distribute the money or not, it's taxable to you, right? So there's retained earnings is something you hear about with C-Corps where they pay tax at 21% flat, or if it's like the global intangible tax, it might be 13%, right? Depending on what you're doing. But you'll hear them say, hey, but the corporation's holding it. So like when Amazon's famous, for doing this, Microsoft's famous for doing this, Apple's, they have billions of dollars that they retain and they don't pay out as dividends to their shareholders. That's usually what you think of when you see retained earnings. So here, it's profits are flowing down to the shareholder. The only issue about paying out that money that's tax, that has an impact on taxes, because if we leave the money in or leave the money out, it doesn't impact our taxes, is what Elliot just nailed, which was you don't have to take a reasonable salary out of an S-Corp unless you're distributing money. And this is misunderstood by a lot of accountants. They always say you have to take a reasonable salary out of a S-Corp no matter what. It's like, no, that's not the rule. It's only if you have distributions do you have to take a reasonable salary. So if you're in the beginning stages of your business and you make 100,000 and you're like, oh man, I have to take a salary, I have to go through that whole rigmarole and do withholding. No, actually you don't if you're going to keep the money in there to grow your business. But the flip side of that is now the money's in the business. So we had this happen about 3 months ago. Client was running a property management business and they had 7 figures of earnings that were still inside the entity when they got sued. And it was somebody trying to take a piece out of them and trying to go after all of their other tenants, trying to organize a class action against it. And there was a pile of money sitting there. And if that happens to you, it's too late. You move the money out, you're subject to voidable transaction or fraudulent conveyance rules. So you want to, if you're in a high risk, like you mentioned, doctor, but really any business, it could be plumbing, it could be the pizza shop. If you have cash, get it out of that S-Corp. Get used to getting it out of that S-Corp, unless you really do need all of that money to continue to grow the business. So anything else on that one?
No, I think that's it.
And we're still getting suggestions on where to go. Somebody says Palm Springs, Palm Desert, because you didn't melt enough in Texas, Dallas. You're like, let's do Palm Springs. No, I used to have a place in Palm Springs. Love the area, Palm Desert. And what else? Somebody said Mexico. They want to do Mexico. Playa del Carmen. I actually gave a talk on a beach in Playa del Carmen once. And I kid you not, the transportation was, we took a cruise out of
That's the way to do it.
Miami and went down to Playa del Carmen, and it was with a IRS attorney, and we both gave a talk in one of the little beach houses.
There you go.
And you can actually write off your transportation. You don't have to get there in a plane. Anyway, that's an aside, but that's really kind of funny. Anyway, yeah, it was not the best talk in the world because
Too much sun.
sun and margaritas and taxes. Like, who the heck goes to a beach to listen to guys talk about taxes? Wasn't super well thought out, but it was great for me. All right, I'm considering signing up with Anderson and contemplating having you amend the last 3 years, as I don't think my CPA's TurboTax gave me all the write-offs that I was eligible for as a real estate investor. I think I may qualify for a greater return, but I don't want to automatically trigger an audit. What do you have there?
Yeah, so getting right to the excuse me, the heart of the observation, it wasn't really a question, but the triggering an audit, that's, I think, a really common scare tactic that's out there, or just ignorance. There's nothing, an audit, amending is not going to create an audit. It does give the IRS a chance to look at it again, but if there's a legitimate deduction there, you have nothing to fear. And so I wouldn't worry about triggering an audit just because I want to amend. As far as the 3 years, it is the limit of how far you can go back with amending. So you are getting to that time area where we might be not able to go much further. So you will want to think it out, because as time goes by, you'll start to drop off on those 3 years and maybe not be able to amend to any benefit. As far as having Anderson, we're happy. We want to help however we can. We don't typically go back and do prior returns because it's not to your benefit usually. If you have a CPA that did some returns, maybe we can review your returns, show that, hey, maybe this was missed or that was missed. And then you can go back to that CPA and they can do it. They already have it in your system. It's going to be perhaps cheaper for you. It does depend situation by situation. We've had some that were so erroneous that, yeah, we took it under our wing. We went back and it costs a little bit more, but we did the full return. But that's usually, you're better off going back to your current CPA, and then we get that all sorted out, and then often the client will come over to our tax prep. So just some things, but the big thing here, I wouldn't worry about an audit.
Yeah, I've never seen any data support amendments triggering audits. I mean, really, there's a point system that the IRS uses on a return when things are sometimes out of the ordinary. So, for example, you may end up with, if you have a home office, I'm pretty sure that that's one of the higher point items, because we see more people get audited as sole proprietors taking that home office deduction to just about anything else. The earned income tax credit, you're about 13 times higher than, or not quite 13. It's about, I guess it's 13 per thousand versus 2 per thousand of audits. So you're significantly 600% more likely to be audited if you take the earned income tax credit. We've never seen that type of data, nor have we experienced it in our practice for having amendments. I've never, ever seen an increase in audit from amending somebody's return to make it accurate. So I would not stop that, or I wouldn't put. I would say that should not be a consideration. Having a return done that's in your favor, that will save you money, is what I'd be looking at. And the only thing I'd be doing in the analysis I'd be doing is the juice worth the squeeze? How much can I save? So if, let's say you brought it here and a team looked at it and said, well, you missed this, this, and this, but we can do it this year and catch up. So for example, under 481, we can grab missed depreciation, make a cost seg election or something like that. And we can grab all the stuff they missed. You may not need to amend. We could still get the benefit, but we're just going to push it all into 2024 or into 2023. But if it saves you $5,000 or $6,000 and it's a simple fix, like Elliot said, you go back to the original preparer. They should have a file in their computer. If you use TurboTax, you should have something there, whatever your login was, and you can make that change. And voila, you end up getting that benefit. So
Yep.
that's
Good job on the statistics around The audit risk. Nobody knows it better than this guy right here.
No, it's publication. Hey, they publish the data every year. Publication.
He remembers
55.
it.
Yeah, well, I spent a lot of time looking at it, but we also know that we do over 10,000 returns here a year with very, very few audits. We had a long stretch with none. It was weird in the early 2000s when everybody was screaming audit, audit, audit. It's like we didn't see them, so we thought maybe they just screwed up our address or something. Maybe they forgot about us.
So
But
you got the audit.
yeah, we got a random audit. We got the employer random audit, and 50,000 of us got this random audit where they went through all of your W-2 and your W-9, your W-4s, and your 1099s. They went through every single one for small. So a few mid-sized employers, they thought that they were going to get some really good data, and we had like two where we couldn't prove the lack of a 1099 because of a corporation, because we couldn't prove the corporations still existed, but it was $750 in 2000. So we were like, fine,
here's 800, go away.
Yeah, it wasn't even that. That was the inclusion. It was like $300. It's like it's less than an hour. They spent a week in our office too. It's like they just come in and
join the AC.
Yeah, that's basically it. You shouldn't fear the audits, by the way. Audits, most of them are correspondence, which means you're just sending in information. About 20% of the audits, which are very few audits anyway, are in person. And if you have an accountant, you're not showing up anyway, nor should you. Don't give them a free interview. All right, next one. Can I continue funding an HSA if I am no longer employed by the company that offered it, but still have the account? Does it make sense to place it into an HSA investment account? What do you say?
So you certainly can continue with that HSA. You may want to move it out, out of that particular one that was under the employee.
Whose account is it?
It is. Yeah, I was just talking with Toby before the show about this. That even if it's an employer sponsored HSA, it actually is the employees should they choose to leave. Something for a long time I didn't know, and I relatively recently figured that out. So certainly before I got to this question though. But anyway, so it's yours, and feel free to keep it, but you might want to move it into another one of your HSAs, and you can actually have unlimited HSAs. We just can't put more in a year collectively than whatever the limits are for that particular year.
Just over 4,000 for an individual, about 8,000 in 2024. For last year, what was it, 7,750 and around $3,800 per, I think it was 3,850 for an individual. So you're just trying to make sure that you're putting that money aside. You get a deduction for it. You don't pay tax on the growth. So if, like, I have one in Fidelity, I'm not saying where you should do it. I just happened to do that. And Fidelity, it was super easy to open, and I just fund it every year. There's no income limitations on it. It's actually really simple. And and this is the cool part, you don't have to use it right now. Like, you could have all sorts of reimbursements, but you just let it grow. You can go back, if it's 10 years from now, you could go back and reimburse all those expenses that were medical, dental, vision, those types of expenses. I think it's covering all, but health expenses for sure. You don't pay tax at any of the growth. And as long as you use it for qualified health, you don't pay any tax on it. So you're getting a deduction, and you never have to include the growth as taxable income or the money you take out as taxable income. And if you hit 65, you can even convert it to a Roth. I think you pay 10%, but it's still really, like, these things are a huge tax advantage. So if you have an employer and you have an HSA, it's your HSA. You leave that, you could roll it into another HSA, or you could just keep the same one. I just wouldn't let your employer dictate what investments are in it. A lot of times they're being very conservative. They'll give you like 5 flavors of mutual funds, and you're just not going to see a lot of success doing that. If you want to manage it yourself, just open up a HSA at any major brokerage house, roll the funds in, and do some ETFs or do some stock investing, do some covered calls. You can go nuts in there. And as Peter Thiel, if you don't know who Peter Thiel is, he started PayPal with Elon. He has a Roth IRA with, I think, $4 billion in it from the PayPal stock. And none of it was taxable, and he'll never pay tax on any of that money. So HSAs are a great place to invest. and to get a nice tax deduction. And then as long as you use it for health, even if it's just reimbursing, like again, if you're not getting a benefit for on your Schedule A for health expenses, because you have the, what is it, 10% adjusted gross income limit? Is it 10 or 7.5 this year?
7.5, I believe still.
7.5, whatever it is. You have a limit on how much on what I can write off. Maybe one of the other accountants can confirm whether it's 7.5 or 10. I always, for some reason, I have 10 stuck
It was
in my
10
head.
for the longest time during COVID, and
And then
I
they
think,
lowered it.
I can't remember if they did or not. I haven't seen on the returns.
But there was a lot of folks, they don't spend enough on their medical that exceeds the AGI limit for them to actually use Schedule A as opposed to using their standard deduction. So they take their standard deduction and they're not getting any benefit for those expenses. Here, if you put it in your HSA, you can use that immediately. You've written it off. There's a deduction for putting it in the HSA, and then you're using it to reimburse your medical expenses. It's great. So it works. See a lot
Like
of
the
other questions.
triple threat, as you call it many times.
Yep, it is a triple threat. It's like boom. All right. I have a K1 that will be late from the sale of an apartment complex in Georgia. I am a married filing separately taxpayer. I will do an extension, but still have to pay tax in April. How do I know how much tax, how do I know how much to pay without the K1? I went through a similar sale last tax season and had to pay a late fee due to the late K1. I'd like to avoid that again. Whew.
Yeah.
All right. What do you do?
So a popular topic that we run into a lot with this time of the year with deadlines and things like that. There is a safe harbor if you've paid in at least 90% of what will be due during your time period before April 15th. If you've paid 100% of your prior tax liability, if you're under AGI of 150,000, or if your AGI is over 150,000, you pay 110%. That's going to help stop the bleeding as far as any taxes and things like that. That's called the safe harbor. Now, should this come up, and it's unfortunate with these K1s, many times this is why Toby's always talking about doing extensions. We try and really broadcast that because these K1s are always being corrected or not coming at all on time, as you've witnessed here. So outside of that, if you can just get some kind of extra estimate of what you think the gain might be, you might want to put a little bit more in, but at least making the safe harbor amounts, if you can get those in, that will help reduce any possible, penalties and things like that. And we do have underpayment, failure to pay, failure to file, and there's interest on all of those. So there's a lot of different things that the government hits us with, but certainly at least trying to get that safe harbor would be a first step, and then anything else extra you could get in there.
So yeah, so you have three ways that they're going to get you. You have, if I did this early in the year and I had a large taxable event, technically you owed the estimated payment in the first quarter, maybe the second quarter, depending on when the sale took place. So you have underpayment penalty that could come there. Was that 8%?
The interest is 8%.
Interest is 8%. So like, ouch.
Yeah.
Then you have failure to pay, which is, hey, I filed, but I didn't pay my tax. And then you have I failed to file and I failed to pay, which is you could be penalized up to 25% of your tax liability.
Correct.
Right. So you have these things that are kind of sticking out at you. So here you are, you're getting a K1. Chances are there's no tax inclusion to you because chances are, again, you're getting a K1 every year. You're not the one that sold the building. It's the syndication. And they're going to give you this K1 and you're like, shoot, I have no idea how big it's going to be. And I can't read the tea leaves. So then the safe harbor that Elliot is talking about is probably your best bet, which is what, 110% if you're over 150.
Right.
So that's the easiest thing to do is look at what your tax liability was last year, 110% of that amount. And you don't have to worry about the underpayment charges. You still may have to potentially worry about if you knew this occurred early on in the year that there was an underpayment on a quarterly basis, but I kind of doubt that in this scenario. I don't think I've never seen that. I've seen it when people actually sold their own property, but I don't think you're looking at that here. Do you ever see that?
I haven't one way or another on this. I just hear the stories from clients from previous years. Usually we get them out there paying that safe harbor, and it's
The quarterly payments,
right.
and then you pay your safe harbor. So you do that, you'll never have an issue. You don't do that, then there's potential interest payments, like not huge penalties. Again, these aren't huge. It was a great one.
Except for the IRS charged interest at 8% because they do that off the ground base rate of interest, and they add 3%. So it's getting up there.
It used to be 6.
Yeah.
Then you were like, whatever, I'd rather keep the money.
Yeah.
Now you're like 8.
So we'll get a little more of a pinch to it.
Yep. So the end of the day, you want to see whether you can guesstimate the amount, but at worst case scenario, you're over $150,000 in adjusted gross income. Make sure that you are paying 110% of the previous year to avoid the underpayment penalties, and make sure you file an extension so you avoid the failure to file penalties. You do that, you'll be good. Even if you don't have the K-1, not uncommon. It's actually fairly common in real estate investing. It's tough to get these numbers out on time, especially if companies are making decisions about cost segregation, how to write things off, or have any issues with their books of trying to determine a position to take. Sometimes they'll come back and amend anyway. So like our suggestion to you, at least my suggestion to you for sure, is file an extension, pay the amount of tax that you owe as best as you can determine, or make sure that you're in that safe harbor to the extent humanly possible. And then that lets you have the summer for people to do whatever they have to do. And it may be where you could actually exert influence. For example, this is an apartment that was put into service last year. It may be that you're having a discussion with them whether they do a cost segregation, and they can do that all the way up until they file their tax return, plus extensions. So if you can, you may be able to get them to do that if it makes a big difference on your taxes. Chances are those types of decisions will have an impact on a lot of the investors. So somebody says, what if you've not filed your previous year for safe harbor? Then you have a problem. Yeah.
Yeah. Then
90% of this year.
Yeah.
That's your other safe harbor. So if you don't have last year to go off of, then is it 90% of the current year, or is it 100?
I think it's
90.
Yeah, 90.
90% of the tax is actually owed.
Yeah, 100% of the previous, but which we don't have here. 110 over 150 and 90 of the current.
Yeah. So then there's 2 safe harbors, 3 technically, because you have one that scales up with the AGI, but you have the last year's tax or this year's tax. 90% of this year or 100% of last year, unless you're over $150,000 of adjusted gross income, in which case it's 110%. All right, enough of that. Gets lots of joy. Figure out what they sold it for and do the best calculation you can. Say how much, because you'll be able to see on your K-1 what percentage interest, and say, hey, what does it look like profit-wise? But I get it. It's tough. What are the benefits of having children as employees? Are their educational expenses eligible for payment by the company?
Well, so some of the benefits is you have somebody to do something. That's what my parents did to me. And so, but they can pay me. And if I'm paid underneath a standard deduction for that particular year, then there's no federal income tax on it. We might run into employment taxes, but that can be worked around as well. So there are benefits as far as shifting income to begin with. That child can then take that money. We often talk about putting it into a Roth IRA, and then that can grow tax-free. They can use that for college down the line or something like that, whatever they want to. As far as education expenses, if we're paying the child to learn about the job they're already doing, that is, let's say you have a C corporation, child's doing the bookkeeping or something like that, they go off to school, off to college, learn about accounting, you can take a deduction or reimbursement of those courses directly related to that employment that the child had. We can't use it if they're trying to learn something like marketing or something like that, unless they were already doing that. And so there are some education benefits there, possibly once they start paying for those type of classes.
Yeah. And the big one is the kids have a lower tax bracket. So like whenever you see kids get hired by a company, it's because they have their standard deduction. So they get first 14,000 they don't pay tax on. And if they're under 18, you don't have to do withholding Social Security. And technically, if they've never paid tax before, they're exempt. They could file exempt on their W-4. So at the end of the day, there's no withholdings whatsoever. You're literally paying the child $14,000 a year and they're paying zero tax. And then you say, well, what, I want to write off some of their expenses. It's like, have them pay for their expenses, right? You'll be a signer on their account anyway if they're under the age of majority. So you can certainly direct those. Yeah. So that's usually what you're seeing. And then there's things like these cell phones, there's computers. If you have a child, like let's say they're good at marketing, then like Elliot said, have them take some marketing classes in college, maybe as part of a degree, still okay. You could reimburse that 100%. But if they're working on the computer, then reimburse the computer. If they're driving around and working with your properties, reimburse the mileage. If they have a space dedicated in their apartment or in a house that they're living in, then you have administrative office for the home, you know, things like that. You start reimbursing those things as well that become deductible. And yeah, there's big benefits. Now, what if they're adult children?
You can still pay them. There's nothing against that, and they could still be in a lower tax bracket, so you might be getting that break, or maybe they're adult but still in school of some sort. Again, maybe they have no income, so they'd be again under the standard deduction. So that's not a problem at all, paying adult children. You just want to take it into consideration.
And parents and siblings.
Absolutely, any family or friends for that matter.
Yeah, and the age limit for not having to do with the withholding is 18, I believe. It's under 18. You can not have to worry about if it's family, but it also can't be a corporation. Corporation, you got to do the withholding. You just run them through payroll and they're paying in towards Social Security. In theory, they'll get that money back at some point, unless Social Security goes the way of the dinosaurs. But we'll see. They're trying to make Social Security benefits non-taxable. I think it's called the you earned it, something like that.
Unicorn is what we call it.
Unicorn. Yeah. But there's an act in it was re-upped in February. I think I did a video on it. Where they're talking about making the benefits, Social Security benefits non-taxable again. We'll see if they get that, but they were going to pay for it by raising Social Security taxes, the old age disability and survivors insurance cost, the 12.4%. They were talking about raising that and making it hitting income above 250,000 with it. Right now it phases out at 168,000, and they wanted to come back in on the rich folk, you know, let's get them.
Yep.
So we'll see if there's the video. Yeah. So if you want to watch about Social Security benefits, you can certainly do that. But a lot of folks get mad because you're not getting a deduction for it, and then you have to pay tax on it. Seems like a double dip by the government, but you know, it's Social Security. Did I answer that one? Yeah.
Yep.
All right.
The long one.
Here's an interesting one. If we live in our rental house for 2 of the prior 5 years to avoid full taxation on taxable gain, take advantage of the $5,000 exemption for married filing jointly, or married joint filing, can the remaining amount we will pay in taxes be offset by losses in our other rental properties? And then they put a big old if we qualify as real estate professionals during the year for filing. Example, if we purchase another property and cost seg it, can those potential deductions be used to offset the taxes paid on the primary residence sale? What do you think?
Yeah, a lot packed in here, and that's kind of why I picked it, because there's a lot of things we could tear apart here. First of all, this 2 of 5 years, what we're talking about is a Section 121, exclusion on the sale of your primary residency. But here, you know, they start as a rental house. So how's that work, Elliot, there when we have a rental house and we have a primary residency? Well, they're going to move into the rental house. As long as they're in there 2 of the last 5 years, they are eligible for ownership and use. Then they're eligible for at least some of that 500,000. Now there's other complications to that, as far as it was a rental first, and we call that non-qualified use. It wasn't being used as your primary residence. And so we take a fraction of that to determine, you know, how much of the 500,000 you can actually take. So
can I stop you right there?
absolutely.
Because if it's a rental property and then you move into it as a residence, then you have period of non-qualified use. But if it's your primary residence, and it has to be, it's not just I lived in it. It was your primary residence for 2 of the last 5 years, but you rent it. So I lived in it for 2 years, rented it for 3, sold it. That's okay. There's no disqualified use. But yeah, so it's kind of a weird rule. So if it starts off as a rental and then you think, oh, I'll go live in it for 2 years, it's not how it works. So if you had a rental property for 10 years and then you moved in it for 2 years, they're going to use that fraction. And so
80% of your 500 wouldn't be allowed.
Yep.
Of the gain.
Well, 20% or
Of the capital gain.
2 out
Sorry,
of 12.
On the capital, yeah.
Yeah, it's kind of a weird thing. So what they do is they say the exemption is, and it's, again, it's kind of funky, but you're saying, here's my period of disqualified use, and you're going to use a portion of the 500,000. It might wipe out the entire tax bill if it's a small enough tax bill, but it's proportionate. It's less than 20% under that circumstance.
Yep.
So maybe you'd have an $80,000 capital gain exclusion, and you'd be like, hey. But there's some other ideas I got here. You finish up.
Yep. So we have that going on, and then would it be enough that we'll be able to offset the rest of our taxes if we qualify as rep status, real estate professional status? That's if you do enough of you're managing your own rentals and things like that during the year. It's possible, because we go on here with an example that you got a new rental, you did a cost seg, maybe bonus depreciation, whatever's left of it, 40% this year, 60%.
You'd never use it on primary sale. You'd use it to offset your highest taxes, right? When you're a real estate professional, that means that you don't have passive loss. You have ordinary loss, and it can offset whatever the highest
bracketed.
Yeah, whatever you're in. If you're in the 37% federal tax bracket, that's what we use. We wouldn't use it against your house, because your house, first off, you might not have capital gains. You're going to have recapture for sure, because you use it as a rental house. So recapture cannot be offset with the 121 exclusion. Only capital gains can. But recapture is capped at 25%. So I'm looking at 37% tax rate, 25% tax rate.
You do the math.
Yeah, I'm going after the big one.
Yeah.
That's number one. If you're a real estate professional, all bets are off. But you don't technically have to be a real estate professional to still get a deduction against your gain on the sale of this type of property.
Right. Because this would be if you purchase the other one, you're going to have, what is it, capital type of capital loss?
You'd have passive
capital loss.
Capital. Well, the nature of the activity flows through when you're selling an activity. So if you have capital gains and it's passive, it's considered passive capital gains. It's weird, right? A lot of accountants are probably going, wait a second, go look it up.
It's in our software.
It's passive capital gains. If I have passive losses from other businesses in which I do not materially participate, or rental activities, or syndication, which I'm a limited partner or a LLC member that's not participating, so it's passive. Those passive losses, yes, will offset your passive capital gains. They will absolutely offset. Not to mention, if you have losses from that rental house that you weren't able to use, those release as well. What is that, 4797? 440, is that the right one?
The release of PALs?
Yeah.
You're 80, well, we track on the 8582.
8582.
Yeah.
Okay, 8582. But you're releasing it. There was,
Yes.
I think there's another.
Yeah.
But it becomes ordinary loss as well against your gain. It gets used against the property, and then you can use it against other things. So like this.
There's a lot of possibilities here to work with.
Right. And I'm going to throw one more at you just to be annoying. You have a 1031 exchange staring you right in the face. If you keep that as a rental property, you don't pay any tax so long as you buy more rental property, right? So if you have a rental house and you're like, hey, I'm thinking about moving into it, then it becomes residence and not an investment property, and I can't 1031 it. So you may inadvertently, let's say I move into it and it's not my primary residence, and I think that I'm going to get this 121 exclusion. You're probably not, right? It has to be your primary residence. It can't just be a residence. But let's just say that you qualified as a primary residence. you're going to have period of disqualified use. So I may not get that big of a benefit, but what I gave up by doing that was an easy 1031 exchange where I just go buy more property. So a lot of times we're going the opposite. We have somebody who's been living in a house and they have a huge amount of gain. They live in San Francisco, Orange County, someplace on the East Coast, Savannah, whatever. And they've had this property go, whoosh, you can go up in value. And they're facing down $1.5–2 million worth of gain. And they're like, man, this sucks. This 121 exclusion is only going to offset a part of it. Then we say, well, hold on. You have 3 years to sell it once you move out to still get that capital gain exclusion. Turn it into a rental. Then 1031 it. And you get the 121 exclusion first, steps up your basis, and then that rolls into the next property. So it actually works out just great. And technically, you could 1031 it into a property that eventually you make into your residence. So long as it wasn't your residence when you bought it, you rent it for 6 months to a year, something like that. Make sure that it's definitely a investment property, and then you could literally move into it. And the tax code contemplates that. You just have a 5-year bar from using the 121 exclusion on that property. That's it. So there's so much in this question. Like this is one of those questions that's like an onion. The more you dig into it, it's got a lot of different levels there, right? And so sometimes rather than tail wagging dog should wag tail, right? Let's have a discussion as to what you really want to accomplish so that then we can give you the right path. And then if something makes a big difference, you could say, you know what, Elliot, I think that I'm willing to do X or Y to save $100,000 of tax.
It's worth a consult, not just trying to sell our services. Yeah.
You want to have somebody who actually knows what they're doing.
Yeah.
The problem is 90% of the accountants would get lost once you went right into the investment field. The real estate professional, they'd be like, what are you, an agent? Yeah. Can some of these exclusions be allowed after the property is sold? Of course. It just depends on whether you meet the rule. So you could sell a house and you're like, I had no idea. And you could still, sometimes it's how you classify it. And then the other part is, let's say that I sold something and it's passive gain and I'm like, shoot, what do I do? Sometimes it's just buying another property. Or if you already have a property, this gets more fun. I've done this, so I can tell you exactly what you do. You have some capital gain or some passive income, and you're like, shoot, you find out in June or July that you have a tax liability. We do this all the time because Clint and I are knuckleheads. And sometimes we don't look at the P&L and you don't really know what it is. We're like, okay, let's run our numbers. We have an idea, but there's, here's an extra chunk of money. And you're like, shoot, that's gonna be taxed as ordinary income. What could I do? You could still do cost segregations for last year, all the way up until you file your tax return. So in October, it's not uncommon for Elliot, myself, whomever, to be looking at people going, here's the few things we could still do to keep you from paying the tax for last year.
Let's call up Eric.
Yeah, we call up Eric Oliver over there and say, like, can you run me a cost seg analysis? We've done it on October 15th. And you're like,
We've been in consults, and Toby reaches right out where the client's there talking to us, and by the end of the consult, Eric's already gotten back with numbers. I remember that.
They've done 26,000 cost seg reports in the last few years. They know their stuff, and they'll know by the region, the area, and they'll be able to use comps to be able to get a pretty good idea. They tend to estimate conservatively, but they get them back quickly. And just so you know, 26,000 reports, 20 audits is what we're looking at this point.
That's a good percentage.
Very good percentage. It's not something that puts a radar on you. It's, if you do it right, you tend to go underneath the radar. Nobody wants to mess with you if you're doing things right. They want to mess with you if you're just doing things loosey-goosey and you don't have professionals. So somebody says, I missed the definition, passive gain. Capital gains from a passive activity. So residential rental property, for example, commercial rental property. If I have rental property and it meets the definition of passive because it's longer than 7 days or longer than 30 with substantial services, there's a whole bunch of different tests. But just think, most people just know rental properties. Okay, it's passive. If you have capital gains from that activity, that's passive capital gains, you can still offset passive capital gains with passive losses from your other activities. So you can cost seg a property. We actually has a name. It's called a lazy man's 1031, where you sell a property and then you were so lazy, you didn't 1031 it. So what do? You cost seg a new property, or you buy another property that we accelerate the depreciation on so we can offset the gain from the property we just sold. Who's the guy that does all those cost segs again? It's actually Cost Seg Authority. Patty has a link. I think it's andersonadvisors.com/CSA. But I'm sure Patty will send you guys the link. Been working with them for years. And they do free analysis if you go through that link. You don't have to do anything with them. It's literally, I use a 7-to-1. If I spend $1 and it saves me 7, I'll do it. It's is the juice worth the squeeze? And then making sure that your tax professionals are proficient with it and they understand what they're looking at. Because I've had so many times where people go to their tax professional and then they don't use the cost seg. Even in the first year, you don't have to make a tax election. You get to take it right away. But I screw that up sometimes too. So I'm a knucklehead. All right. Enough on that?
Yeah.
We could spend all day
Yeah,
on that.
that
Like we
one
could
could go
probably
forever.
spend an hour on that one question. Can we use CSA for primary residence sale? No. It has to be an investment property for cost seg because it has to be depreciable, and you can only depreciate properties if they're used for investment. All right. How long? Oh, this is great. Hey, this is the perfect question for that. So how long do I need to have a property in service to rent to be able to deduct bonus depreciation from a cost seg study? What do you say?
Yeah, there isn't any time frame. I mean, theoretically, 1 minute would be enough. 1 day would be enough. Reality is that you want it to be reasonable, probably a reasonable amount of time, but there isn't any. It just, you had the intent to put it in service. It was available for rent. That's it.
That's it.
That is it, right?
And by the way, it doesn't have to be rented. It just has
No.
to be available.
Yep.
So the day that I put the for rent sign and it's available and it can be rented that day, it's in service.
Yep.
If it's December, so I'm going to give you guys a scenario, real life scenario. Somebody bought an Airbnb. They put it in service the last 2 weeks of December. They rented it like 3 times. Average use was 4 days. That's not even a rental activity. That is a trader business. So they cost segged the property and all of that bonus depreciation. They were in a year with 100% bonus depreciation. Right now we're looking at 60. There is legislation that's passed the House to bring it back to 100. It's sitting with the Senate right now, and those guys can't get out of their own way. So if they do anything, it'll be right before the election. But they take that big loss and it offsets all their other income because they materially participated in the Airbnb. And before you lose your mind and say, there's no way, my accountant said this is not a thing, it's absolutely a thing. It is because in the regs, if you rent a house for 7 days or less, average use, it is not an investment activity. It is a trader business. And the only question is it active? Are you participating in it and subject to material participation rules? And are you providing substantial services to make that trigger employment taxes like Social Security? That's the only question. Or is it passive? I'm just a passive business owner, in which case it's passive. It's a trader business that's creating passive losses.
Yep.
Yeah, so that's all it is. And it's in the regs, it's in the tax code. There's tons of case law on it. There's lots of, like the IRS this is not new, but if you put that puppy into service in that last month or two, all you doctors or all you high income people, you should really consider, hey, maybe I should buy an Airbnb at the end of every year, self-manage it so you don't have to worry about material participation. If you manage it yourself, you automatically qualify. And you could take those losses and you offset your W-2 income with it. We've seen how much we know who you're talking about, the surgeon.
Yeah.
Brain surgeon. He bought how much was that house?
Oh,
Right before the end of the year.
yeah. For some reason, I want to say 800.
It was right around 800,000, but the deduction was about 250.
Yeah. Yeah.
So, so how much did he save tax wise?
I think that was the one we called Eric up.
Yeah, I think it was. You could do it every year.
Yeah, 37% on 200. That's 74 plus half of that.
Yep.
You're looking north of 100 right there, cash.
Yep. Kind of funny. Somebody says, how do I join a group for 100 a month? It's not 100 a month. It's less than that. But we call it our platinum membership. I just say it's less than 100 because I don't want to say the numbers. And if you want to learn more about that or anything else, come to the TaxWise, excuse me, I want to say TaxWise because you guys just did one. Tax and Asset Protection Workshop. We're going to go over land trusts, LLCs, corporations. Clint does a great job, or Brent Nagy. I've been grabbing a client of mine for the last 10 years, or ours for the last 10 years. Brent, he worked with Rich Dad, was handpicked by Robert Kiyosaki, really great investor, and he's a pilot. Like if I could get him to commit to a day, he'll come out and teach it too, just because he gets it from the client side. Like he was just a real estate investor. He had a band, that's what he did. And then he learned to be a real estate investor, and he's completely independent, killing it in real estate. But he did everything we teach from the client side. So when he talks, he's like, I was right where you were at. It might have been 13, 14 years ago, but I know exactly what you're going through. So he comes in and he teaches. So sometimes it's Clint, sometimes it's Brent. And it usually is my sorry mug teaching the tax. As I'm trying to get Amanda to do it. I'm thinking like, it's more fun. Let's get everybody involved, right? Anyway, my asset is in a self-directed IRA. I'm assuming if I sell it, the money is considered income and I'm taxed on it like any other income. Can we just stop right there?
Yep.
Let's just kill that assumption.
So there's a whole lot of misconception going on in this question. You have an asset in a self-directed IRA, fine. If you sell it, is it taxable? No. You can sell anything you want within the IRA and the money just goes back in there. There's no tax event going on when you're in a retirement plan such as that. So no, we are not taxed on it like any other income. It's quite the opposite. And you can do that and you just get more cash in there, and then you go out and get your other investment within the IRA and it will continue to grow tax-free. That's it.
It's an exempt entity. So as long as it's in there, the only time you have to worry about tax in a self-directed IRA is if you have unrelated debt financed income, which in English means you have a loan on the property that's creating the income, in which case then a portion of it may be subject to tax because you use leverage. That same rule does not apply to a solo 401k or a 401k. So if you're investing, it helps us to know, hey, if you're talking to us, we're like, hey, you know what? If you do it over here, there's a small tax. You do it over here, there's not. Do it over here, right? But there's no income. Now let's answer the rest. Also, if I use the money from the sale on that property for the purchase of a different property not kept in the self-directed IRA, can I avoid taxes? What is your suggestion in this kind of situation?
So now what we've done, we sold that property in there and we want to take the cash out. Now we have a taxable event. Okay. Can we do things out to offset there, outside? Yes, but know that that will be taxed and we're not going to be able to do anything on that particular transaction. Tax will be paid unless we find other things, such as you go out and you get maybe one of those short-term rentals. We just spent, 10 minutes.
Create a loss to offset.
Exactly.
And you're saying, hey, I want to distribute the money. You have the penalties depending on what type of IRA. It doesn't say Roth IRA, so I'm going to assume that this is a traditional 10% penalty plus your tax. If we can make it low enough, we're good.
Yep.
And or if you convert it over to a Roth, that's another way, but then you're still in the plan. I wouldn't get it out of the plan.
No.
Honestly, it's good to have it in the plan. You're going to end up paying tax on it, but it might be 20, 30 years from now. Let it grow. Yeah. And so, so the answer is don't take it out unless you want to incur tax. But if you're going to incur tax, minimize it by using deductions from other activities to offset it. And so we have this all the time where somebody has money in a defined benefit plan, an IRA, a SEP IRA, a simple IRA, a 401k, a 457, whatever it is. And they had a really bad year, or they had a black swan loss event where they were able to maybe they qualified as a real estate professional and they accelerated a bunch of depreciation into 1 year and they ended up with like a $500,000 loss. And they're like, I could carry it forward, or let's create $500,000 of income by taking money out of an IRA or rolling it into a Roth, in which case that's a very wise decision to do that. I would probably say keep it in a plan, but make it a Roth rather than take it out and use it individually. Somebody says, but don't you need to pay for all the repairs with the money from the self-directed IRA, and all the rental income has to go back into the self-directed IRA? Yes. You cannot pick up a hammer and do work. That's your personal services making the asset more valuable. You can't do it in an IRA or a 401k. You're a disqualified party. You can't do that. Hey, Patty, I'm going to give you a heads up. Do you think you could find the link to the to my YouTube page? It's actually just my main page, but I'd like to make sure everybody understands that they can get a free estate planning starter kit to do the emergency binder. And I'm throwing that at you. I think we have 2 or 3 more questions, so I just want to make sure you have that link. And I'll go to it before the end. Hey guys, because you're sticking with us, I want to give you guys something. And I will give you that when Patty gets us that link. But we have a few more questions to go through.
Well, they've already done 180 questions almost.
They've answered, yeah. See,
177.
177 plus there's 9 more. So our guys are absolutely killing it. I got Arash, Amanda, Patty, Matthew, Jared, Jeff, Jen, Trish, probably more, Dutch. Yeah, all answering questions, guys. These are tax attorneys and CPAs and EAs. These guys are just killing it. And you're not having to pay for it.
Right.
Oh my God. Somebody says, why do you do that? It's like, because I had to save up to my first and only paid consult with a CPA where I just wanted to.
Yeah.
It was demoralizing. It cost me $300 and was in 1997. Still remember it. And I had to save up to meet with the accountant who made me feel like an idiot. And that's why I said, I'm going to learn this stuff because I don't want to feel like an idiot. Did not appreciate that. I did not appreciate somebody taking the money, and I saved up for it. I didn't have any money. I was not a wealthy person. And they took that money, and I was like, no, you shouldn't have to do that. You should be able to get the answers. People shouldn't hit you. They should answer your questions first, and then you can decide whether or not to engage them. I would never, ever engage that guy the way he made me feel. It was horrible. All right. Just started an Inc. taxed as a C-Corp. So he just has a regular C-Corp. What is an accountable plan? Is it something I need to join before I can get a benefit of it? Can any reimbursement be expensed with my personal name and get reimbursement, i.e., or example, like health, dental, vision, and cell phone? Do I need to have a cell phone account in the business name?
So yeah, very common questions within this little one here. So I picked it. What is an accountable plan? It just means reimbursement. It's a fancy IRS term, means reimbursement. You personally pay for something with your own money on behalf of the corporation. It's for a
Like this.
like that.
I have my cell phone and I pay for it personally. Go ahead.
And you're just simply getting reimbursed for that by the corporation because you used it for the corporation business.
Yeah. So
That's an accountable plan.
as long as they get a benefit.
Yep.
And no difference than if like an accountable plan could be any written agreement where the company agrees to reimburse you for expenses you incur on its behalf.
Yeah,
for its benefit.
It doesn't have to specifically say accountable plan above it, but you probably want to have a meeting, memorialize it in some written doc.
We do it in all of our documents as a matter of course. Like, so if you've ever done an LLC tax as an S or a C Corp or an S or a C Corp, it has to be a corporation, guys. Taxes as a corp. It can't be done through a partnership or a sole proprietorship. In order to be reimbursed, you need to be an employee of the organization.
Exactly. And yeah, just saying that there is reimbursement, that's sufficient right there. It doesn't have to be all fancy, although nice documents are out there saying, hey, I got an accountable plan. So
and then it's who, what, where, when, why, right? The easiest one is, who was it that I paid?
Why?
Why did I pay it?
How
What
much?
was the purpose? When was it? How much was it? Any other facts and circumstances, like why was it beneficial to the employer? So it's like, these are easy. Hey, my employer says to me, you need to be available to do real estate deals and answer questions all the time. So he says, I need to trade my LLC for a corp. No, we can make a corporation tax election for your LLC. So your LLC doesn't exist to the IRS. It's like a vessel, and you get to tell the IRS what it is. So you can just say, hey, that's a corp. Hey, that's an S-Corp. Hey, that's a partnership. Hey, ignore it. It's invisible, and tax the owner. So there's all that fun stuff. Patty, I'll give them that in just a second. I'll give them the link. I'll tell you when to give them the link. It'll be fun. We're going to keep you guys on a little bit. So, but we will give it. Oh, she just did it anyway. Patty, I need my button.
I
I
know.
need my button.
We don't
for
have the
Patty.
buttons today.
No, you're boo. No, I'm not going to boo you. You did a great job. So anyway, we'll give you. I'll explain what that is. Patty's already throwing it out there. She's like, yeah, let's give the candy out.
As far as it being the account and the business name, no, the phone would be in your name because you're the one paying for it personally, and then you turn it in for reimbursement. So you typically wouldn't, if you're going to have it reimbursed, you wouldn't have it in the business name.
Absolutely, it doesn't have to be you. And then if you're doing the health and dental and vision reimbursement, that's called a health reimbursement plan. It has to be a C-Corp. It could be a nonprofit. It could be an LLC taxed as a C-Corp. It can't be an S-Corp. When they pay for health insurance or health expenses, it's treated as wages to the individual.
Correct.
So we don't want to be in that situation. So C-Corps become your best friend when you have a lot of medical expenses, and that includes for dependents.
Yep.
So if Elliot was my dependent, let's say he was my parent or he was my sibling or
I'm older.
something, but he qualifies as my dependent, and I'm caring for him, and it's $25,000, $30,000 a year. This is something we live with. Like, we see these. It's not uncommon for our clients. I can reimburse that entire amount out of a C-Corp. Has to have income, but I get to write it off. So then side gigs become very lucrative. I have cancer and have crazy medical bills. Exactly. And I'm sorry you're going through that, but they don't unless you go over, it is 7.5%. Unless you go over 7.5% of your adjusted gross income, then you can write it off on your Schedule A. And still, most stuff isn't covered, right? This just lets us do it 100%. So the health reimbursement plan out of a C-Corp becomes really good. And we do have clients that are doing that, where it is $25,000, $30,000, $40,000 a year. And it works. Last question.
Last question.
Hi, Toby. Does the assignment, I like that they're putting it to me, makes me feel special. Does the assignment of beneficial interest in a land trust count as an installment sale for tax purposes? Who's responsible for property taxes in such a transaction? What do you think?
So just like our last question, a lot of misunderstanding here.
Mm-hmm.
When you take a property and you put it into what we call a grantor trust, a land trust, it's not a taxable event, at least federal income tax. Now there could be, so there's certainly not an installment sale. We have no sale going on at all here.
No.
There might be a transfer tax in some crazy states like Pennsylvania, is where we run into a lot of problems.
Yeah, we don't like Pennsylvania. they hit you for like a 3% transfer tax.
Yeah.
But it's not a sale. When I put my property, here's an easy one. Like, let's say it's down in Florida. If I put it into an LLC, first off, and I have a loan against it, I'm going to owe doc stamp fees. I'm going to get taxed. If I do a land trust, I do not. So we like the land trust. Now, if I sell the beneficial interest, so I own a property, let's say it's 123 Main Street, Toby Mathis, trustee, and I sell the beneficial interest to Elliot, I can do an installment sale.
Yes.
It's under section 453, and I could choose to recognize that income over a long period of time. Depreciation, I recapture in year one. Capital gains and return basis is spread out over upon receipt in the year that it's received. I could do that, though, by selling the beneficial interest, but just me, Toby, putting a property into a land trust does not create a sale. There are states, I think it's really Pennsylvania is the only one that I know of on the land trust, where they are like, no, we want you to pay a transfer tax, but that's something completely different. In Clark County, where I'm sitting right now, where we're sitting right now in Las Vegas, if I put property into an LLC, I don't pay any tax. If I take it out, I do. If I put it into a land trust, I don't pay any transfer tax. But if I take it out, I don't pay any transfer tax either. So in this county, we always use land trust because we don't want to trigger it. Florida is another one. Florida, you don't want those doc stamps. Or if we're in Tennessee, we want to make sure that we meet the fonts exclusion, family-owned non-corporate entities, so that we don't have any excise taxes. Like there's all these little nuances that are triggered when you're doing these types of transfers, which is why you work with somebody who actually knows what they're doing, so they can check and say, hey, by the way, this is how you want to do it to avoid a nasty surprise. We see the folks get the nasty surprises all the time, and then they come to us and go, what do we do? It's like you fire the party that did the nasty surprise and you don't do it again. Here's how you do it. So, it's like one of those things. There's little time bombs set up here and there, and you just want to make sure you're not, stepping on one. That's always fun when we get into those.
Yep.
All right, this is where I was going to say, if you guys go to my YouTube, the very first video, like I put it up there, there is an emergency binder. And I'm just going to say two things on this because I've seen it come up repeatedly now. Number one, everybody needs an emergency binder. It's not what you think. This isn't a will. This isn't a living trust. This is instructions should something happen to you about how somebody can access everything from your social media, understand what your bills are, understand what your wishes are for your funeral, burial, if you gave service to our country in the armed services. You have nuances on how to receive benefits, and also you're entitled to certain honors that they want to make sure they get. Plus, civilians don't always understand the nomenclature that you use and the verbiage that you use, and you can actually help your loved ones by writing it out a little bit for them. That's an emergency binder. There's also things like who's your doctor, who's your dentist, who's going to care for your pets, right? Or if you have minor children, who are their friends? What do they like to do? So it seems so weird, right? But we've had over the last 3 or 4 years, over and over again. I've had friends, 2 friends lose their lives unexpectedly in their 30s in this last 2 years, and successful people leaving behind a lot of uncertainty that's easy to fix. So I created an emergency binder. You can absolutely go there. It's free. You're not going to get, there's not a secret, hey, it's $10 or this or that or that. It's absolutely free. Download, it's about 82 pages. And you're going to say, what's 82 pages? Go through it and you'll see what I mean. And don't worry, you're not going to write all your passwords in the binder. So if somebody finds your binder, you print it out and they're going to have access to your entire life. You take that password sheet, you'll see it's numerical, that there's no way that they could figure it out without having both documents. And you take that password sheet and you put it in a safe, or you give it to your lawyer, or you give it to a trusted advisor, or you hide it somewhere and let your family know where it is, so that in an emergency, it seems so weird, just being able to get into your Facebook and let people know what's going on makes the world of difference from people that are, gosh, I mean, I'm thinking about Bren Moorhead that we just lost. And his daughter, it was like about 2 weeks before she could get in and get access and let the world know of what had happened. And it's like you're just looking at it saying, hey, let's make it easier on the people behind us. It's again, there's no cost to it. Why do we do it at no cost? Because you should do it, and I don't want there to be a barrier. And it's the right thing to do. Hopefully you do that. Now you still should have a will or a living trust. I'm going to say a living trust because I hate probate and I hate seeing what it does to families. But let's make this really simple. Let's just agree. Maybe this year we're going to actually put some things in writing, print it out and handwrite it out, or you could fill in the forms online, whatever float your boat. It's not super difficult. And if you just took it and just did little pieces, get a 3-ring binder, put it in there, say, hey, in case of an emergency, look right here, and it'll give your where can the finder be found. It's a free link. Patty just shared it. It's on my YouTube. It's the first video. It actually starts talking to you. I do that once in a while. I put a video and it says estate planning starter kit. That's it. Watch the video, fill it out. I have a video that actually walks you through how to complete it, so you know what all the sections are. It'll take you about an hour, but do it for your loved ones, because man, I've just seen so much anxiety and stress caused by people not doing some basic things. Even if they do their trust, it's you don't want people to be sitting there going, gosh darn it, what did Elliot want? How can I honor him? Or things like, shoot, who are Elliot's friends? Who should I be calling? Who should I invite to the,
Crickets.
to the, yeah. You want to have that stuff, right? You guys have all had to go through it, I'm sure, with a parent or somebody or a sibling. But it's absolutely free. Speaking of free, also our tax and asset protection events, absolutely free. You can get to those on our website at any time. We do them just about every other week or every week. So you can learn about the different types of entities and how they work. And you can always ask us questions. Just go to Tax Tuesday or email Tax Tuesday at Anderson Advisors. Elliot has to read all those.
I don't have to. I love it. It's a lot of fun. And remember, put the Orlando mention that you were at Orlando.
If you were in Orlando, just put I was in Orlando and you get to the top of the pile. Everybody else can ask questions.
Certainly get additional consideration.
And yeah, we'll definitely be pulling those ones for the next few weeks and do it. But Tax Tuesday, Anderson Advisors, and go to our website at andersonadvisors.com. And in the interim, you got 2 weeks off. So we will see you in 2 weeks. And as always, we appreciate you coming on. There are 13 open questions. There are over 235 questions that our folks have answered in writing. If you are waiting on an answer, just hang tight. What we will do is we'll say adieu and bid you blessings for the next 2 weeks. And then we will stop broadcasting the video, but we will keep this open until your questions are answered. So if you're waiting on an answer, do not worry. We're not going to kick you out into the cold. Our folks will stay on and answer those questions. Big old thank you to Amanda, Arash, Dutch, Patty, Matthew, Isaiah, I know is floating around out there, Jared, Jeff, Jennifer Phipps, who been with us forever, Trisha. Thank you guys for answering all those questions. It's easy to get to sit here and I can have a conversation with Elliot. These guys are sitting there just nailing away and answering questions. And I see the questions. These are not simple questions that people ask. They're usually I could never get an answer from my accountant. We'll do our very best to give you a straight answer and give you some direction. You put that into the Q&A. So we will see you. Anything else?
No, thank you.
All right, guys. We will see you in 2 weeks,
safe.
and we'll continue to answer your questions. Email us in. Give us some good questions. Use good grammar, though.
Hey, thanks for watching. Click the link so you can join us live and get your question answered by myself and my tax team.